Welcome, everyone, and thanks so much for joining us for today's webinar. My name is Marianne Hensley. I'm the VP of Media Operations here at FreightWaves, and we are happy to present today's webinar in partnership with Transfix. Today, we're going to be discussing the results of a recent shipper survey that FreightWaves partnered with Transfix to develop, which will ultimately result in a detailed white paper that will be available to download in the coming weeks. Before we get started, if you have any issues during the webinar, please feel free to reach out through the group chat function in your webinar console. Also, be thinking about the questions you'd like to ask our speakers during the audience Q&A following the presentation, and you can enter those directly through the Q&A section of your console. We'll answer as many of those as we have time for following the presentation. At this point, let's go ahead and dive in. As I mentioned, FreightWaves recently partnered with Transfix to conduct a shipper survey. And the study centered around how shippers are dealing with freight market volatility, and it aimed to gauge their confidence around budgets and planning as we head into the new year. So without giving too much away, what we walked away with is an understanding that many shippers are still predominantly relying on their own internal data and historical trends when it comes to setting budgets and planning for the future. And that's really counterproductive when you consider the need to assess what the data is telling us about the market as a whole in order to counteract market volatility as it occurs. So to address the findings of the study and share insights around how shippers can best work to combat that volatility, I am pleased to introduce Kevin Hill, Director of Research for FreightWaves, along with Carol Park, who's the Head of Enterprise Business for Transfix. Kevin and Carol, we are excited to have you here. So why don't you start by telling us a bit about yourselves? Carol?
Yeah, Marianne, it's a pleasure meeting you, and thank you for inviting us. I think before we go on, I'd like to do a brief introduction of what Transfix is. So Transfix is a leading freight marketplace connecting shippers to a best-in-class national carrier network. We provide sustainable solutions both for our shipper and carrier partners that are powered by technology and industry experts. Primarily what I focus on is really the growth and the strategy within our enterprise shippers. And I think the main points that I try to do is how can I bring value? What are the data points that I can provide? How do I aggregate that data to really think about some strategic decisions as they move forward into into the near term?
Very good. And I'm Kevin Hill. I'm the Director of Research for the Freight Intel Group here at FreightWaves. And what we do is we do a lot of deep dive, white paper, long form 20, 30 page reports on macro trends in the freight markets. It's basically our proprietary research desk. We do that through surveys like we're discussing today, as well as some quantitative research and using sonar as well. So one of the big things that we do is we look at the markets. We look at we look at the markets and kind of see trends and how supply and demand fundamentals go into that and what moves the freight markets. Mostly it's that those load volumes and tender rejections or spot pricing. And to jump right into some of those market trends over the last 2 or 3 years, as we all know, 2018 was a very volatile year. In the markets is probably the most volatile through about 7 or 8 months through that cycle as anyone's seen since deregulation. So it's important to provide context. Carol and I will be talking a lot about market volatility, where we were in 2018, the volatility or the lack of volatility really in 2019, and what we're forecasting for 2020. So to do a little bit of a recap on 2018 and really started the fourth quarter of 2017, where you had some fundamental factors come into existence that really moved the freight market. The first one, the leading one, was the tax cuts. So the corporate tax cuts created additional round of spending and manufacturing, industrial growth, and consumer spending as well. And you saw that in about mid-year of 2017. And then leading into the September area where we had those dual hurricanes in Houston and Miami. The Houston hurricane created a lot of flooding damage, and FEMA government recovery efforts sucked quite a bit of truck capacity out of the market, and it created more tightening going forward. And then you had the ELD craze that the first deadline was in December of 2017. And as of September, the research shows that only about 50% of small carriers were compliant. So you had this learning curve, and you had a little bit of a panic in the market where, how much is this going to hit productivity going forward? And we see on our chart here, coming in from 2017 into 2018, we normally have that big seasonal peak in the summer months, and we can see that in the circle, and we can see that back in 2016 and 2017 in our chart. But what we really don't see is a big spike and real extreme capacity tightening in the first quarter of any year. But we saw that in 2018. It was a rough market, and so it was a very rough market, tough to find trucks. And Carol, is that something that you guys saw in 2018 with the year of two peaks?
Absolutely. I think it's interesting that you pointed out even the Houston hurricane. We actually, as a carrier, we did deliver water into that area towards that tail end as well. It was definitely an interesting year going into it. I don't know, as we went into the year, if we really had understood just the gravity of how volatile things really were going to be. And I think it's interesting to see, the Sonar data now, to look back at historicals and really be able to take a step and really analyze what's happening. My question is, though, Kevin, can you describe a little bit more the differences between that blue and the blue and the green line highlighted here?
Sure, I certainly missed that coming in. The blue, or let's start with the green. The green are DAT spot rates. So these are the national average for dry van spot rates. The blue mountain are new Class 8 truck orders. So where you see in 2017 going into 2018 those that rise in volatility with spot rates, you saw truck orders follow along. So while we had a tightening market throughout 2018, rising rates, tightening capacity, you also, that blue kind of gives you the context of capacity that would be coming into the market eventually. You saw, and it kind of describes, it's hard to measure capacity coming in and coming out of the market, but the blue, those new Class 8 truck orders kind of gives you the backdrop of small, all carriers of all sizes, really, from the mega carriers to the small fleets. We're all expanding. They're all buying, whether it's new or used trucks, hiring drivers, increasing wages, and really jumping in the market to chase rates.
Yeah, I think this is a very interesting point where you talk about last year's business was good for carriers. Carriers were expanding. And then we see what happened in 2019. In 2019, I think the latest even news about the most recent news, having one of the largest carriers recently shut down. How do you think that when we think about more trucks that are being actually removed or reduced will impact the industry moving forward?
So I think in 2018 you saw a rush to chase rates. 2019 has been a very low volatility year. And the next slide here that we're looking at isolates the DAT long-haul van freight rate. So we can see that huge peak in 2018. And after that, you saw loads kind of stagnate. So you had this increase in tendered load volumes. You had a tighter capacity because of the issues or the dynamics that we described before with the ELDs and hurricanes and tax cuts, and you saw that slow down toward the second half, or in the second half, really, of 2018, but you saw all of this capacity come onto the market, and where we have it red circled is around the beginning of 2019, where all of those dynamics that were moving around kind of caught up to one another, and you saw excess capacity in the market. Load volumes really didn't take a hit. They're more stagnant. We've seen that most of 2019, and that is, is that something that you noticed coming, basically about 12 months ago into 2019?
Yeah, I think seeing this now, it kind of shows you that huge drop where we're seeing rates above that $2 mark, and then kind of narrow down to just a little over $1 here. Absolutely, I think particularly if you're a carrier that is probably more responsive and more reactive onto the spot markets, it was a very tough year. It was really kind of helpful, the fact that for us is that we actually have a very strong mix between the contract and spot. But really, our biggest intention is to work directly with strategic carriers and with our shipper partners and just be prepared for times like these. So it was tough, yeah, but we're going through it.
Yeah, it's a cyclical market, right? I think 7 to 18 months is the normal cycle. We had a huge bull run in 2018, and we are dealing with basically the hangover effects of that in 2019. And we see this really clearly here in our next chart. So what we have here in the orange are outbound tender rejections. And the blue is an index of or outbound tendered load volumes. So we can see the tendered load volumes that they go through seasonal patterns, but they've been mostly stagnant over the last 12 months. We hit a bit of a rough spot around May and June, kind of in your typical run up to peak season. Right now, crossed over where we had easier comps, and load volumes in 2019 surpassed 2018 year over year in late July. And we've been averaging about 4 or 5% above 2018 volumes here in the back half of 2019. But the orange line really tells the story, right? Because back in the heightened market of 2018, say the summer months of 2018, you had rejection rates of 20 to 25%. So what that really essentially means is for every 100 loads tendered, 20 to 25 are rejected, which is a huge number, right? It shows that capacity was super, super tight. You saw that fall off in the second half of 2018 and really fall off after basically this peak holiday season here that we're in right now, January of 2019. We went from about 14% to 7% tender rejections in a matter of weeks. And we've seen it kind of go along the trough. We were talking about spot rates slide or two ago, and we're in that $1.40 to $1.45 range most of this year, which is about the operating cost per truck. So it shows that, especially with Celadon, as you mentioned earlier, we've seen quite a bit more, like a tripling of closures this year compared to 2018, and well above 2017 as well. So what you're seeing is that's probably going to remove capacity from the market. I think the Truckload Profitability Partnership, their average OR, or operating ratio right now, is about 97, 98. So they're running about 2 to 3% profit margins, which is tough to endure, right? Yeah,
that's interesting. I think not to mention too, there's recent news. I think California and New Jersey, really sort of the actionable changes that will be impacting owner operators for the gig economy. It'd be interesting. I'm curious to see how that's actually going to impact later down. But for me, when I look at this chart, Kevin, is seeing that drastic decrease for that orange line. It's surprising, and then it's not so surprising. I think when we actually go into Q1, we're thinking, okay, this is something that we understand is going to happen. Now, when it just continued into the summer and even throughout the rest of the year, I think that was the more surprising end of it, just to see that we didn't see any kind of more volatility pertaining to that.
Yes,
but for us,
Oh, go ahead. It's been a very low volatility year. We went from 2018, which was extreme volatility, to almost no volatility. We've seen pretty stagnant load volumes. The tender rejections have all been, between 4.5% to 6.5%. No real run up. It's just been a very steady market. But as we both know, it's a cyclical market. and the lifespans are typically from 7 to 18 months. So we are, I'm thinking we're probably 12 to 15 months into the cycle, because we saw probably September of 2018. Certainly, once we hit October, everything kind of slowed down, capacity really loosened. You saw a lot of trucks entering the market. We had, we go back to new Class 8 truck orders, and you can also mention that was a 15-year record we broke in 2018. So there's a lot of capacity on there, but 2019 has shown that overcapacity it doesn't stay there forever, correct?
Yeah. I think for us, from what we're hearing from our shipper partners, particular enterprise shipper partners, is it was a good market for them. They were talking about, historically high acceptance rates, everyone meeting their KPIs and really reaching demand. And so definitely this year was probably more focused on strategy and thinking about how do we continue this? How do we make sure we remain flexible? What are those conversations in the event that something does happen? I mean, and it's a business also. The retail business itself it's cyclical, but it's also incredibly volatile. And then you compound that with just what's happening in just the transportation industry alone it's fascinating.
It is fascinating. It definitely is. So what's in store for 2020? Well, let's take a look here. So what we have on this chart, we have in the blue background, that's year over year quarterly GDP growth by percentage, right? Starting in
the blue?
That is the blue, yes. The blue is that. And what we saw on that was an accelerating GDP growth from about the middle of 2017, when the tax cuts were instituted, until about the middle of 2018. So there's about a 12-month cycle there. And then growth slowed. I mean, we didn't slide into a recession, but the growth slowed from, say, 3% to 2.5%. So we had a slowing growth, which kind of compounds the overcapacity as everyone's buying trucks, entering the market. GDP starts decelerating. In the orange, we have outbound tender rejections. And you see, it's pretty clear where you see the deceleration of GDP growth. You also see tender rejections fall. So it's a really nice correlation. We have somewhere around, probably in the first quarter of 2020, somewhere around 1.7 to 2% GDP growth is what we're forecasting. We're also forecasting basically an acceleration of trucking company closures, especially for small fleets, whether that's voluntarily or involuntarily. We're seeing capacity kind of leave the market. We have a strong unemployment, right? I think we're below 4% right now. So there's a lot of options for drivers to go into construction, warehousing. If the price of oil actually rebounds from here, then that's going to be another reason to leave trucking and hit the oil fields. So we're looking at probably a moderation of tender rejections, probably about a 5 to 10% Q1 2020 rise in spot rates year over year for the first quarter. But I think that's going to clear things out for a reduction in capacity. We'll probably see a tightening of capacity. We'll probably see good load volumes again this year, and that sets the stage for an increase in volatility in 2020.
Hey, Kevin, this is a very insightful slide. Thank you for this. I have a few questions. You mentioned on oil and fuel. What other variables do you think may impact just the volatility of fuel itself, as we're hearing this in recent news?
Well, we are just right around the corner of IMO 2020, which a lot of people in transportation and trucking aren't too familiar with. It's more of a maritime regulation, and it's really switching fuels from high sulfur fuels to low sulfur fuels. And how this affects trucking is that those low sulfur fuels that ocean-going vessels, whether it's bulk or container ships, will have to burn is a middle distillate, which is the same part or the same molecule, if you will, as diesel. So if you can imagine, if take a million long-haul trucking or trucks, and if you switch their fuel from diesel to gasoline, what do you think it would do to the gasoline prices, especially in the short term?
It's going to tighten.
It is, yeah. So it could be anywhere from 25 cents to 50 cents increase in a gallon of diesel in the first half of the year as everyone kind of deals with the rollover into this new regulation. So I think that's kind of a wild card that could be introduced in the market. And we haven't seen too many signs of a big jump. But if you throw out a geopolitical risk and the price of oil bounces up sharply, if you get volatility in the oil market as well with the IMO 2020 regulations, you could have volatility that feeds right into the trucking market.
Yeah. I'm from California, so understanding what those fuel surcharges do to the retail sector, I'll be prepared for that. So looking at this chart, so my final question here as I look at this chart is, if I can read this correctly, is GDP, we actually see it somewhat tapering down, and we see rather with the orange line of tender rejections that it's picking up. It looks like it bottomed out in the summer. It picked up a little bit, and we're going to see a little bit more of a slight tightness over there. Are there any outside things that maybe we should prepare for going into 20 that may affect us even further?
I think trade deals. I think trade deals will have a lot to say about it. Of course, you have the China trade deals. I think maybe they have some kind of agreement for the new NAFTA. I can't remember the acronym for the new deal. I think it's USMC. But I think those are two big wild cards, how trade policies going forward, I think is a big thing. And you always have to think about the consumer, too. The consumer's charging ahead with the economy. We're kind of in a little bit of a manufacturing and industrial recession right now. So certainly if that picks up as well, that's just going to increase the volatility in 2020.
Okay, great. Thank you.
Yeah. And that kind of the volatility in 2020 and that forecast brings us to the survey. And it's a survey that Transfix and FreightWaves conducted. It lasted 9 questions, 119 shipper responses. And the philosophy behind the survey and what we wanted to gauge in market sentiment among shippers is, how confident shippers feel heading into 2020 with rates, capacity, and their budgets, right? So all shippers prepare budgets and just how confident they are, or maybe how lack of confidence, but just to really gauge that, and really just gauge their perceptions. So let's dive into it.
Yeah.
And the first slide that we have up here is how shippers manage volatility in 2018, and what they did, and could you provide a little bit of color on that, Carol? Especially, do you think in 2018 shippers were reacting to the market?
I would say that they were casting a wide net. And I think just for the audience here, I'm going to just read out some of the options here. And so the question was, when capacity is tight, like it was in 2018, what were the primary tools that shippers used to handle line haul rate volatility? And we saw an astounding split, half of 50% saying that they expanded their 3PL freight brokerages in the network. And I think overall they expanded carriers, both from an asset and from other 3PL and broker. This isn't surprising. I think during this period when you had seen in the previous slides, the volatility, it's expected. But to the degree that we saw, I think that was what was unexpected. You compound that with rather kind of the big scare of what ELDs are happening. Now we also have Monday looming as well, so we'll see how that's going to be impacting in the short term. And then you had really just the climate. I think there was absolute chaos during that time. We had just a record number of natural disasters, hurricanes, tornadoes that's really impacted business. And so I would say shippers, it was just natural for them I think this made them reset and relook at their business holistically, just even from the granular standpoint. And by that, the following too is, it says the next two options, both in the 40% percentile, they rebid line haul rates with all their carriers. again, I think this is part of the partnerships and understanding who are your strategic carriers and your partners, what kind of transparency do you have, and really talking about what your goals and concerns and objectives really are, and to hone that in. I mean, the reality is that this is a relationship business, right? We're here to take care of each other, and we want to work together and make sure that we're all doing things well. It's interesting because coming into this side of the industry is that transportation it's a bellwether of the economy, but we don't actually always naturally see that through when you're a consumer. At least I certainly did it as a consumer. And finally here we talk about extending delivery timelines to their customers to compensate for deliveries. Now, I don't know about you, but the last thing that I'm going to do if hearing from shipper is going back to your customers and letting them know, hey, this isn't going to make it in time. You are not going to be able to have this product for you to sell that's essentially going to help the business top down or bottoms up. So this isn't, some of these numbers it's surprising, but also not so much.
Sure. The extending delivery timelines, renegotiating those or moving those around is certainly the last option that all shippers want to do, right? They need to find capacity, and certainly it's kind of a waterfall of the orders, basically the order of operations, finding that capacity. Yeah. And it kind of goes down to, in volatile, anything can be volatile. You never know when volatility is going to jump up and bite you, right? So it's really, how you prepare your budgets. And that's our second question. What data points and technology do you use to budget full truckload rates? And, sometimes shippers have a limited visibility into the data they see. It is oftentimes their own historic data, and which can be problematic on benchmarking. What do the responses for this question tell you, Carol?
Yeah, so I think going back again, the question was, what data points and technologies did shippers use to budget full truckload rates? The responses, I think the astounding was their TMS. From what I'm hearing from shippers is they're spending an incredible amount of money in investing in their TMSs, and it's a strong integration depending on what you have and how custom and bespoke that is, or if it's just kind of out of the box mechanisms. Nonetheless, what I'm seeing here is that they are very inclined to look at all the data within their TMS, and why wouldn't they? It's all centralized there. What's interesting, though, is that I still do hear from shippers and meet with shippers where they will still have a Tableau report that's outside of the TMS. They will gather and analyze certain data points that's living outside the TMS, and for whatever reason. And so I think this kind of starts to show you a little bit of a gap of maybe from what you're seeing in terms of data and data quality, but more or less even data clarity. Second to that is, they're evaluating internal historical line haul rate data. Makes sense. That's probably the best gauge for your business, is to use your first-party data and think about what's the year-over-year growth, how is that affecting the budget, what are my goals, and what's happening on the sales side. Third is they're benchmarking against third-party rate line haul data providers. That's about 34% of the audience that had, or the sample size that had, agree with that. I completely agree. Continue to do that. Use as much data that you have, leverage what you have, and use it, look at it, analyze, spend that time. And the last three that we see is data from 3PLs and freight brokerages, data from your asset carriers. Again, we are definitely one of those that we encourage this. I think one of the major touch points that Transfix we do think about is every single movement that we have as a data point that you can evaluate. But I think the important part when we think about benchmarking that data is really how do you convert that into your strategy? What are really the insights that you can use that establishes the next steps for the near term and the long term? And then lastly here in 4%, I think this is interesting, is they're talking, shippers are saying that they actually look at the flat percentage of sales or cost of goods that are sold, which isn't surprising. You have to know what's actually coming down the pipe to think about preparing how many trucks are you going to use, what the inventory is going to look like, what the routings are going to look like, how is this going to impact the DCs and the fulfillment centers. So this using software and using that data, it's encouraging to see.
It is. Those are excellent points. it's all about data, right? So the more data you have, the more informed decisions you have. And one of the more surprising results that we had in the survey were really, let me flip over here, and here we go. 75% of shippers said transportation costs had the largest impact on their business. And I was a little bit surprised by this. How about you, Carol?
I was very surprised by this. But also, I guess, given the market shifts that had happened, I suppose that the budgets have expanded a bit. I think in previous years, we did see a lot of earnings calls, which we talked about unforeseen transportation and logistics costs that had come into play. I'd actually like to turn this back into the audience. Audience, do you agree that the majority of your costs are actually running into transportation? We'll give it
yeah, give it 15, 20, about 30 seconds, I think, is what we're going to give it. Here, one of the most surprising thing is that, all the money and sophistication that goes into manufacturing, production, raw material procurement, I would think that would have more of an impact on the bottom line, but it was a clear winner. I think it was transportation costs were twice as much. And I think some of that, and we talked about this yesterday, I think, some of that is that they can control some of those costs. It's kind of in their control, whereas trucking is completely outside. The transportation costs are kind of completely outside their control because it's a strictly kind of a supply and demand pure market.
Yeah. So it looks like we got some quick results here coming in. Looks like they're still coming in. We have about 38.9, so just shy of 40% that are saying yes. Maybe 75% is an egregious number, and about 60% saying no. So it'd be really, I'm actually curious, at some point, maybe later down the line when we can talk to the audience a little bit further, what is an appropriate amount that you would consider as a transportation cost as part of the budget?
Yeah. How integral is it, or how we know from earnings reports in 2018, as you mentioned before, that a lot of companies miss their earnings because of transportation. But how big of an impact are transportation costs, and it is a little surprising that it's above manufacturing, but as we mentioned, you really don't have any control over your transportation costs. It's basically what the market bears.
Yeah, I suppose that question is probably really geared towards what happened, sort of unearthing what happened in 2018, and so 2019 certainly was a different time. That said, I would say procurement off those costs, on average, every year, you have a 3 to 5% cost savings goal that you need to adhere to. And then that goes in line with, obviously, what your sales are and margins are. And so I'd be curious to see a little bit further digging into this particular data point.
Yeah, definitely. And if we flip to the next chart here, we kind of go back in time to 2018 and how shippers reacted to that unprecedented volatility in the market. And the question was, when line haul rates are volatile, how often do your transportation providers either try to rebid rates higher or decrease the amount of capacity allocated to your freight? And, overwhelmingly, most shippers go into a rebidding cycle, or their partners do. What did you make of that, Carol?
Yeah, I do. And seeing that shippers are, in addition to their annual bids, they continue to have their annual bids, and for those that are preparing for it, good luck. But also, I'm seeing a little bit more of mini bids pop up as well. That's popping into it, and I wonder if this is really kind of a natural evolution of just being more proactive and letting carriers know a bit in advance of, here are some things just to be on the lookout for, whether that's just extra inventory that's coming down the pipe that maybe wasn't part of the original bid that's being contracted down, or it's a little bit of just a reduction in strategy in terms of the carrier breakout as well. But, when I actually see this and I see the majority have, I think we tend to have that this is as a negative connotation, that carriers are coming back and they're talking about adjusting their rates, or they're talking about what their capacity looks like. And I kind of look at this as it's a proactive communication. It's a discussion here. Now, with all that said, one of the ethos that we do have is that we talk about guaranteed capacity. So as a carrier partner, when we're talking and we're having these discussions with our enterprise shippers, we're being very honest about it. We're talking about here's what our network is, here's kind of, the load carrier ratio that we have, here's really what the machine learning is telling us, in addition just really with those that are on the floor and our carrier managers are tactically talking about and communicating what these shifts are incurring and how this is going to impact. So I think taking all of those into consideration, yeah, does this happen? Yes. Is this going to continue to happen? I'm sure it will be. But I hope that the way and the content of the discussion really are shifted more towards strategy.
I couldn't agree with you more, Carol. The point on right there. So basically, with all the rebidding activity, 95% of shippers rebidding when volatility hits the market. What are the basically the next question really is, what are their thoughts about going forward in the next 12 to 18 months? How confident are they in their current transportation budgets? And this can be a bit of a trap, since we had a very low volatile 2019, and we know it is cyclical. So capacity's leaving the market, low demand, any critical events, we might well see a lot of volatility, maybe not 2018 and 2020, but we're probably heading into a more volatile market. So the next question is, how confident are you about your current method of budgeting full truckload line haul rates over the next 12 to 18 months? And 80% of shippers are confident in their current budgets. And I bet you if we asked the same question in early 2017, we'd probably gotten pretty good or pretty much the same data. If we did that 12 months ago or back in the beginning of 2018, I guess 24 months ago now, it would be very unconfident. What do you make of these results?
Yeah, I would say it's not surprising. I think given the amount of resources and the amount of time and energy that is being put into creating these budgets, I would say that there should be a high level of confidence that's coming into this. But I think I want to turn back and shift it again is, we can be confident about things, and we can say that this is, in theory, what we're forecasting or making projections to happen. That said, we've just seen what we saw in the previous slides, and I think I can't speak for everybody here, but really the volatility that does make you have to flex up and down. So yes, have confidence in it, understand what it is, but what are those backup plans? Who are those strategic partners that you can kind of turn to and have these discussions when things do come apply? I think that's really talking about the preparedness to move forward and stick to those goals that you have. So, the extremely confident, I see that it's 80% we're seeing confident, but I think to understand is the majority we're saying somewhat confident. So when I take this, it's like, I think I have it. I think I have it. I'm not entirely sure, but I think I have it. And so that's sort of where I would border on when we talk about confidence levels here.
Exactly.
Yeah. Kevin, when I see something, what are you hearing on the street out there when you talk to some of the shippers, when you talk to your carriers? Like, what is happening here?
I think we're seeing a pickup in volatility right now, or at least a stronger market for carriers and transportation providers. I think we are, and certainly we're. I think last year we had 4 weeks from Thanksgiving to Christmas. This year we have 3 weeks, and I think that the confidence levels of carriers are going higher right now. I think we bottomed out in our carrier sentiment surveys. We bottomed out in the beginning in the third quarter, like basically July, August type of time frame where we surveyed carriers. And the last
Yeah.
2 quarters, we're seeing a surge upward. So from sentiment surveys from carriers, we are seeing that things are looking up from here. And I think it's going to be a stronger freight market in 2020. And that's kind of really what we're seeing. And certainly going back to the shipper side and going through our results, it's evident, how important strong advisors and strong providers and strategic partners are needed to really manage transportation spend in both the short term and the long term. And and I think this highlights the importance of having a lot of data, a lot of support, because you can't really control transportation spend. You can't control the volatility in the market, but you can certainly manage it as best you can. And part of that is having a lot of strong partners around you.
Yeah, absolutely. I'm definitely hearing the same similar sentiments, both from not only our shippers, but also our carrier partners as well. We even see the winters that are starting, in my opinion, living in the Northeast in New York, we're definitely seeing some of that winter creep up a little bit sooner than I would like to. I would like.
Yeah.
And we're already seeing that impact some of the business. We've seen across, I think, even some of our shippers where you have seen an increase in some of the spot inventory that we are seeing is that effect. I think come Monday, too, is going to be, I hope everyone is prepared for Monday. And for those of you who know, that's when the ELD mandate is fully expected to take effect. And everything that's happening across from California and New Jersey, just climate change altogether, it'll be an interesting year. I'm looking forward to it.
It definitely will. It definitely will. It has all the markers, critical event-wise, to increase volatility in the market. And we can never discount what a polar vortex will do. I lived through one of those trying to cover trucks. I think it was 2014 or 2015, and it was a wild 6 weeks. I mean, you same day. If you're trying to cover anything same day, you just couldn't, especially anywhere in the Midwest or kind of the New York, PA area. So that can spike volatility, and you don't know it's happening until it happens. I think there was 4 or 5 polar vortexes that just bore down on the Midwest, one after the other. So any critical event like that, geopolitical, it could be any number of things, and we're setting up for a tighter market right now, and I'd be watching out for critical events like the ELD turnover. You have the drug clearinghouse that's taking effect in January, and it's hard to model that. IMO 2020, so there's a lot of things to look out for. So to summarize, preparing for this cycle, this maybe exciting 2020. What's your advice, Carol?
Yeah, I mean, I did just touching on the word. When you said polar vortex, I just got chills right now. Yeah, born and raised California girl, now living in New York. That's always fun. But yeah, just I think just to sum up here is there's 4 points that I would recommend, and also that what I'm hearing across the board to do for those. First, identify those strategic partners. Have those discussions, proactively have those discussions. Be very clear about what your objectives and what your concerns are ahead of your bid, ahead of your fiscal cycle or fiscal year, before when you're actually really talking about budgets, and get a sense of what's actually happening with your partners. Second, you have it. Ask for data-driven insights from anywhere, from all your partners, from your third-party, I would say, like load carriers that you have, to help solve for the inefficiencies that's probably standing within your supply chain. I think it's hard to see when you're kind of knee deep in it. It's hard to kind of think about how you're going to get out of it. But when you have a chance, and I think that for the most part, a lot of the wonderful people here that are working on this, they really do have this holistic view. But oftentimes when they do have this holistic view, they think about where are the limited resources that they have, what's their bandwidth, what's their time constraints. And so leverage your partners, talk to everyone. And it kind of leads into number 3, leverage your data to benchmark it against. Talk to your carriers specifically, talk to, for us, is for our shippers, they immediately come to us and they ask Transfix, what are you seeing out in the market? What are the things that we should be prepared for? What about certain regions? What about certain areas? How is this affecting the market? I think that having those conversations are so critical and it's so key. And lastly, I think this is probably just kind of says it for everybody, but I'm going to reiterate again. Secure your routing guide with trusted carriers. And by trusted carriers, those that provide you, I think the initial three, provide you those extra insights. How are they helping you drive your strategy? What is the value that they're bringing to you, not only as a carrier, but as a partner? And be prepared to flex up and down to cover those blind spots. I assure you that when you actually have those strong relationships people continue to talk about, they will help you uncover those blind spots. In fact, they may even be privy to, depending on how transparent you naturally are with your partners, they will be able to kind of help you and guide you in that circumstance. And so, I would say these are the four that I would recommend.
Perfect. That sounds great. So that kind of wraps up our presentation. Let's dive right into Q&A. I know we have we have maybe 6 or 7 questions on the board right now, so that's great. So if you haven't submitted a question, please do so.
Absolutely. And Kevin and Carol, thank you both so much for sharing your perspectives and walking us through that survey. I know I found it super interesting, and I think it'll help everyone on the line as we kind of look to prepare for what's ahead in the year to come. So first question for Kevin. Do you believe it's easier today to predict where the market is headed because there's currently more access to third-party data than ever before?
This is a great question. And it starts off, it's hard to forecast or predict anything. But I will say that I joined FreightWaves about 9 months ago and started getting access to better and better data that we have just in Sonar, and starting to research and using other third-party data to complement that. And I have to say that my insights into that has broadened significantly. So I think it is much easier to predict, maybe not predict 6 months out, but you can predict really near time and extrapolate that a little bit into the future to where you have much better day-to-day decision-making than I did back in 2011, 2012 in a small brokerage where we had almost no information. So it was hard to predict, and we had no control over what we could, our pricing, where we saw capacity. It was almost like a guessing game. So the world's come quite a ways from those days, and as I say often, the freight, logistics, transportation is going through a tsunami of data, and some of that's from brokerages like and 3PLs like Transfix.
Great, thank you. And next question for Carol, really related to Transfix. Carol, can you explain a bit about how Transfix helps shippers to benchmark their data?
Yeah. Without giving our secret sauce here, what I can share is that there's a number of things that are in play. One is we actually have an incredible team here. We have an incredible team, a mix of industry people, technologists, and really kind of just everyone that is just heads down, and they're working and they're really understanding what's happening here. And it kind of spans across from our tech team who are really building this technology, machine learning. I mean, we talk about AI here, I think, kind of across the board as if it's kind of table stakes now, but we take it one step deeper in a subset of that of machine learning. So constantly, every single time there's a data point that is coming into the wheelhouse, how are we aggregating this? What are the insights that we are pulling in? And you compound that with, our team as a whole, we are also moving freight. We're moving freight, and so every single time from point A to point B and what we're hearing on the tracking, on stuff, we use it to put it into and up-level it and put it into really what our forecast is. And that's in real time, truth be told. From that impacts our carrier strategy. I mean, we're talking about tactical, real-time communication that's happening upstream. And we have to go ahead, take a step back, aggregate that, and really help unleash that for our shipper partners. I hope that's kind of best without really revealing what that proprietary platform looks like.
Absolutely, and understandable. I appreciate that. Next question here for Kevin. Could you elaborate on weather's impact on the market? And do you believe that current weather projections could be a valuable data set to evaluate when making market predictions?
I think weather has a huge impact on freight, and a lot of that impact is on local conditions or local markets. So it's not really a nationwide or a nationwide bending of supply and demand, but a local. So if you have bad weather in Chicago, it's going to affect that market. If you have thunderstorms or tornadoes rolling through Dallas, right, you're going to have very short-term effects. But then you have the big weather, hurricanes, right? And we saw that certainly in 2017, where that can exacerbate volatility. We also saw that in the polar vortexes that whipped through 4 or 5 years ago. So weather like that can have long-term effects. And when I say long-term, maybe 2, 3, 4 months of market disruptions. But in using forecasts to kind of calculate capacity can be useful. We did some research on that for this presentation, but we didn't put it in because of the length. But we look at 3-month forecasts of weather. We have a meteorologist here at FreightWaves, which is always good, and we're seeing I think above normal projections for precipitation, if I can say it right. In the Midwest for later this winter, like January, February, March, and kind of average to below average temperature. So you could have some weather disruptions in the Midwest going through the first quarter.
Perfect. Thank you, Kevin. And next question, which I can open up to both of you. Maybe Carol, if you'd like to speak first. What do you see with capacity in the first quarter of 2020? And will trucks be tight? And do you see rates going up with shippers? Is that something you can speak to?
Yeah, I would say, I think from what I'm hearing across from shippers, it really just depends on when your bid cycle is happening. So, again, like it's sort of a bit of a recency over relevancy effect that tends to happen. And so depending on, during a depressed market, and when they do that, you're going to try to secure as much capacity as you can. And when you actually work with your carriers, you may actually see a little bit of I would say, a cost savings because of just the recent issues or kind of the recent climate that is occurring now. So I would maybe time that. That's probably one of the things that I'm looking at. As far as first quarter, I think based on what Kevin's forecast is seeing is that it's bottomed out in the summer. And so when it's bottoming out, we definitely do see that inclining or increasing. Now, how do we think that's really going to affect the market? I think there's so many outside variables that we haven't taken into consideration too. And so that is, I think, one of the biggest stuff that has happened is really what climate change is doing. What is that impact going to look like on the Northeast? And as Kevin had talked about is, this goes on for 3 to 4 months. So there's your quarter right there. And from, I think, off that bat for Transfix for us is that we're always gauging what our capacity constraints are, if we do have any, and we're always thinking a step forward as we're using the charts that you guys have just so in our I think partnering up with the meteorologist and understanding what that is to foreseeably think about so we can flex up and down, and constantly having those conversations with our shipper partners when we're thinking about what are the headwinds that you foresee as well. Let's time that together. Let's have that discussion. We all need a seat at the table to really map that out.
Good points. Very good points. And generally, I agree with that forecast as well. I'll add a caveat to what I think will happen. Is normal economic conditions minus critical events. I think that the first quarter of 2020 will be much better than the first quarter of 2019. We're going to see the first stages of a tightening in the market, and it'll be much more healthy than 2019. And I think it's going to set the stage for capacity to leave the market to where we get into the second quarter. It might be late second quarter, early third quarter, where we'll see a much more balanced market than we've seen over, since June of 2017. It's going to be much more balanced. I don't think demand is going to outstrip supply like we saw in 2018, but it's going to be much more balanced.
Excellent. And we will have time for one more here. So Kevin and Carol, is the coastal transition going to maintain, or do you believe it'll swing back to the prior balance of West Coast versus East Coast ports?
That's a very good question. I'll go first here. I think we're seeing more and more deliveries in ocean containers going to the East Coast as an option. I think the Panama Canal, that expansion helps out a great deal. And I think something that we're rolling out and really watching is the spread between West Coast ports and East Coast ports. And we've seen more capacity go into the East Coast. But I think, Long Beach is a huge port, and I think it will continue there. You always have AB5, both in California and New Jersey, right? So things might go to Savannah more. But the whole independent contractor versus employee is something that everyone needs to watch out for.
Yeah. I think it's interesting. There was one of the highlights that we had that I believe I looked at some months ago, maybe earlier this year. And I think interesting talking about West Coast volumes. Looking at port volumes, there was one coming out of the LA market is that during that period when really they sufficiently couldn't take any more, we actually saw the inventory move north towards Washington and towards that Seattle, Tacoma area. And so what does that spill over, and how do carriers actually react to something like that when you realize your inventory that was expected in Southern California is now shifted to the Northwest? And so I definitely would maybe look at what those port volumes are, looking at how, as Kevin had mentioned, is how is trade going to impact on a global scale, but on a domestic scale as well. So can we say that it's going to be one versus the other? I think it's still TBD on that one.
Awesome. Well, thank you guys so much for taking the time to be here with us today to share your insights, Kevin and Carol. I think this has been super helpful for those listening in, and I know I enjoyed the conversation very much. We appreciate all of you in the audience for taking time out of your afternoons to be here and for sending in your thoughtful questions. We appreciate Transfix as well for partnering with us on this research and this webinar today. Great partnership here, and we're looking forward to working with you guys again in the future. To everyone listening in, we appreciate your time today and hope you'll join us for another webinar again soon. Have a great afternoon.
Yeah, thank you, Marianne and Kevin. Happy holidays, everyone.
Thank you, Carol and Marianne.
Bye.